Welcome back to Business 506 at Cal Lutheran. We're going to review disability insurance. By the end of this lesson, you should be able to explain some of the definitions of disability, understand standard provisions of a disability policy, and discuss the sources of disability income. The purpose of disability income insurance is to replace the income from when you're working after you become disabled, whether that's from illness or accident. The probability that you will be disabled for at least a 90-day period prior to age 65 is fairly high. From the table below, you could see that the longer the time horizon, for instance at age 25, there's basically a 50-50 chance that you could be disabled for a 90-day or longer period. As we get older, that probability goes down, mainly because there's a shorter time horizon there. Some definitions of disability. There's a few different ones here. The first is an inability to perform all the duties of your own occupation. The next is inability to perform the duties of any occupation for which the insured is reasonably fitted by education, training, and experience. The third is an inability to perform the duties of any gainful occupation. And the last is a loss of income test to see if there's actually a negative impact to your cash flow. So, for example, if a surgeon hurts his hand in some sort of accident, under the definition of the own occupation, he would be totally disabled. And under the definition, the second one, of any occupation, so for example, teaching at a hospital, he would not be disabled. Third, inability to perform the duties of any gainful occupation. That could be outside of teaching, outside of medicine, just anything. He's not disabled. And on the loss of income test, he may be partially disabled. To that point, if he was earning $300,000 a year as a surgeon, and now he can be a teaching physician at a university or hospital, but they only pay him $120,000, good news, he still has a six-figure income, but it has dropped substantially by more than half. So on the loss of income test, he is partially disabled. Continuing on, most insurers now combine the first two definitions for the initial period of disability, so right from the get-go when you get hurt. Typically 2 years, the insured's disability is defined as their own occupation. Now, to continue on with receiving disability benefits, the second definition comes into place, and that is they can't be able to perform any occupation for which they are trained. So the example just kind of reiterates what we talked about with the hunting example with the doctor. This is a dentist. So he develops arthritis. For the first 2 years, he would be considered totally disabled. However, after that period, he could work as a dental supply rep and would thus no longer be considered disabled. There's a presumptive disability concept, which is a total disability is presumed to exist if the insured suffers total and irrecoverable loss of sight in both eyes, or total loss or use of both hands, both feet, or one hand and one foot. Partial disability is defined as the inability of the insured to perform one or more important duties of their occupation. So for example, someone is injured in an auto accident, and after several months of rehabilitation, they recover enough to go back to work on a part-time basis, so partial disability benefits would come into play. There's also residual disability. It is a prorated disability benefit that is paid to an insured whose earned income is reduced because of accident or sickness. The daily benefit period is the length of time that benefits are payable after the elimination period is met. For a short-term disability policy, they typically provide benefits for 6 months or less. On the long-term disability plans, they have extended benefits after an employee has been disabled for a period of time, usually 6 months. On an individual policy, not an employer group policy, long-term coverage has a varying elimination period. It may be shorter, it may be longer. I've seen as long as 2 years. Why would you take a long elimination period? Basically, two factors come into play. One, it would save you money on premium. And two, if you have other reserves available so that financial hardship doesn't come into play, that it may be a viable choice for you. The elimination period is in effect a deductible. It's the period during which benefits are not paid. Typical elimination periods range from 30 to 180 days. Some of the policy provisions. One is waiver of premium. If you are disabled for a long period of time, and typically it'll be 90 days or more, that future premiums are waived and you will still receive benefits. Some rehabilitation provisions are that they will cover vocational rehab programs, and they're designed to encourage you to return to work. There's an incontestability clause. This is similar to life insurance in that after the policy has been in force for 2 years, the insurance company cannot contest it. The flip side of that is at the outset of the issuance of the policy, the insurance company has 2 years to find a material misrepresentation or other error that would enable them to rescind or revise that policy. With regard to renewability provisions, these provisions govern how the policy can be renewed. Most of the good company policies are guaranteed renewable to a certain age, and others are non-cancelable. That certain age historically is 65. Why? Because after that has been the traditional Social Security retirement age where Social Security retirement benefits kick in and disability does not. There's also non-stacking provisions, and that states that if there are multiple policies in place, so let's say I'm eligible for $5,000 of disability coverage. That's what I can purchase by the insurer's definitions. If I were to buy 3 policies with $4,000 each of benefit and I become disabled, I do not receive $4,000 3 times over, $12,000 a month, when my income was only $5,000. What the insurance company would do is they would prorate the benefit to whatever the maximum they would have normally allowed. Some other riders, cost of living riders, it allows you to periodically adjust the disability benefits for increases in the cost of living as measured by the Consumer Price Index. There's also an option to purchase additional insurance. Under this option, the insured has the right to purchase additional disability income benefits at specified times in the future without proof of insurability. This can be very handy, especially if the insured starts to develop health issues or is in a fairly risky occupation. There's also Social Security riders. That rider pays the insured an additional benefit if they are turned down for Social Security disability benefits. And there's also return of premium. This rider pays back some of the premiums paid into the policy after a period of time. Some of the sources for disability coverage include workers' compensation programs, state temporary disability laws, Social Security disability benefits, and employer-provided plans such as sick leave, short-term disability, and long-term disability. A note on the employer plans. Sick leave, typically that comes automatically to the employees based upon whatever schedule the employer establishes for that. The short-term and long-term disability typically are going to be optional coverages that the employee has to purchase during the annual enrollment period. Last bullet point, individual disability income insurance policies are also available and are another source. With respect to workers' compensation program, the benefits are paid as a result of injuries as follows. Well, first of all, it has to be in the workplace. There's a waiting period that's fairly short, typically less than a week. The benefit is usually 2/3 of a worker's weekly wage, subject to certain minimums and maximums. Workers' comp is not going to be adequate for high income earners. It's designed for the average worker out there. Last bullet point, 4 classes of disability. We have temporary total, permanent total, temporary partial disability, and permanent partial disability. Some state temporary disability laws, also referred to as non-occupational disability laws, provide benefits as follows. Employees are subject to both a minimum time worked and minimum wages paid prior to disability, usually a week. Benefits typically are 1/2 to 2/3 of average weekly wage for some period prior to being disabled, subject to certain minimums and maximums, and benefits generally paid up to 26 weeks. So again, it's a temporary disability. Social Security benefits, in contrast, are paid to workers who meet the following stringent requirements. First, that they have to be eligible to apply and collect, which is a function of both age and work credits, number of quarters earned. They have to meet a 5-month waiting period, and they have to satisfy the definition of disability. They must have a physical or mental condition that prevents them from doing any substantial gainful work and is expected to last at least 12 months or is expected to result in death. On the employer-provided side, sick leave. Sick leave plans, also salary continuation plans, are usually short-term in nature, uninsured, and fully replace lost income without any waiting period. Another employer-provided sick leave plan is short-term disability, usually insured, and they replace a portion of lost income after a waiting period. Employer-provided short-term disability insurance plans replace a portion of lost income after the waiting period. They have to be members of a covered class of employees, full-time, actively working, satisfy the waiting period, and show evidence of insurability if required by the employer or the benefits manager when the employee is hired on. Some of the exclusions on the short-term disability. The period for which the employee is not under a physician's care, disability caused by intentionally inflicted injury, and the period of disability did not commence while the employee was covered under the policy. Some benefits could be either flat dollar amounts or a percentage of pay. Again, those will be subject to minimum and maximum limits, and taxable to the extent they are not funded by employee post-tax contributions. With regard to contributions, the employer contributions are fully tax deductible and result in no taxable income to the employee. On the employee side, the employee contributions are not tax deductible. So that's how you get the tax-free benefit. Use your take-home pay. On short-term disability, the elimination period, generally there's no elimination period resulting from accidents, but for all other causes, it's 1 to 7 days. It'll vary. Again, check with the benefits manager at the company. Benefit period is fairly short, typically 3 to 6 months is the maximum what you're going to see, and it will be integrated with work comp benefits, temporary disability laws, and Social Security benefits. With respect to long-term disability, employer-provided long-term disability income plans replace a portion of the lost income after a waiting period. Some eligibility conditions, well, this is similar to the short-term disability, covered class, full-time, actively working, satisfying the waiting period, and showing evidence of insurability if required by the benefits manager. Some of the exclusions on long-term disability, period which the employee is not under a physician's care. So if the doctor says that you got better, you're not under the physician's care, well, that would not be covered. Disability caused by intentionally inflicted injury, so attempted suicide, things like that. The period of disability did not commence while the employee was covered under the policy, so either pre or post employment, not during employment. Acts of war, participation in assault or other felonies, mental illness, alcoholism, or drug addiction typically will be excluded, and pre-existing conditions. Some benefits on long-term disability will be either a flat dollar amount or a percentage, again, typically between half and roughly 2/3 of your pay, subject to certain limits, and generally are taxable to the extent they're not funded by employee contributions. And on the contribution side, that it's the same as the short term. So what to remember is, if you want to receive a tax-free benefit, use after-tax dollars. Elimination periods are longer with long-term disability. This way it integrates with the short term. So for example, if the employer has a 6-month benefit on short-term disability, typically the long-term disability policy will kick in at the 6-month mark. So there's no double coverage. It's a smooth transition. Benefit periods can be as short as 2 years and as long as lifetime. And again, long-term disability will be integrated, as short-term is, with other benefits, work comp, temporary disability laws, Social Security, other insurance, potentially pension plans if the company has a defined benefit pension, sick leave, and earnings from employment. Now, individual disability income insurance plans are similar to employer-sponsored plans, except that the individuals have to purchase them directly from the insurance company or through various professional associations. So, in summary, we reviewed some of the definitions of disability, gone over some of the standard provisions of a disability policy, and reviewed some sources of disability income. Thanks for your time.